All right, so welcome to this section. Okay, so right now we're going to be looking at what chart patterns. Okay, we just briefly explained what support and resistance are, and then when price gets to support and resistance level, there are certain things price does. Okay, for you to know if they are going or if they are going to break through the support or resistance level, or if they are going to do what? Reverse. Okay. So now this is what will lead us to understanding chart patterns, because all what you are seeing here, they are all candlesticks. So if you don't really understand the type of candlestick price is going to use in breaking a particular zone, you may find it very difficult to know if the zone is going to break or not. Okay, so now chart patterns are specific formations or structures that appear on price, okay, on price charts, and are believed to represent potential price trend or reversal. Okay, these patterns are created by price movements of an asset over a period of time. We can use chart patterns to analyze market sentiment, identify trends, and anticipate future price movements. We have two types of chart patterns. We have the continuation chart patterns, and we have what? The reversal chart patterns. All chart patterns are formed either as continuation pattern and reversal patterns. Okay, now there are patterns. I will be naming these patterns for you. We have the head and shoulders. Okay, head and shoulders, just as the name implies, head and shoulder patterns consist of three peaks: a high peak, which is the head, flanked by two lower peaks, the shoulders. Okay, it suggests a potential trend reversal from bullish to bearish. We also have the inverse head and shoulder, which is a reversal or opposite of the regular head and shoulder pattern, signaling a bullish reversal from bearish to bullish. Okay, so let me go over to the chart where I will be explaining this to you. Okay, it's even here. Okay, it's even here. Just as I open it, I'm able to recognize it as easy as possible. Now, you need a trained eyes to do this. Now, any of you can point me where on this chart I can see a head and shoulder pattern. Okay, point me where on this chart I can see a head and shoulder pattern. It's already here. I can see about two. Okay, I can see about two, but majorly they are the inverse head and shoulder pattern. But let me switch it over to the opposite side so that you can see it. Okay, it's clearly in front of you. Okay, so show me where can I see the head and shoulder. Okay, okay. Right, perfect. So that's a nice one. All right, so remember it says it consists of three peaks. Okay, we have the first one being the first shoulder. We have the neckline. This is the neckline here. And then we have the head. And then we have price come back to this level, giving us another shoulder. And then once we have a break out of that neckline, okay, we have that drop. Okay, it's just as simple as that. Okay, and now there are tools on the TradingView platform where you can get the head and shoulder pattern. Okay, I didn't send this link to the other group. Let me quickly send this to the other group. Okay, so if you come over to your tools, you can see the head and shoulder pattern. It's already marked out here. Okay, because I use it frequently. I love the head and shoulder formation. Okay, so you can see it here. Left shoulder, neckline, head, neckline. You can use any of them. And then right shoulder, and then we expect the massive drop. Okay, and then we expect the massive drop to the downside. Okay, that's the way it is. All right, let me see. So that's the way it is. You get your head and shoulder patterns. And then for the inverse head and shoulder pattern, it's still the same thing. But this time around, the head is at the bottom part. We have the left shoulder, the head, and then the right shoulder. Okay. If you understand, just drop 111 in the chat section so that I know that you are following. Okay. Just drop 111 in the chat section so that I know you are following. All right. All right. All right. All right. That's nice. That's nice. Okay. That's nice. Yeah, the next pattern recognition form. Okay, the next pattern, now we also have it here also. Okay, I can also identify it here. Left shoulder, neckline, head, neckline continuation, right shoulder, and then a breakout. Okay, they are still the same thing. You see two of them, they look identical. Okay, they look very, very identical. All right, so these are things you need to understand when it comes to what identifying chart patterns. Okay, so yeah, 111, we are good to go. We are good to go, Shaya. All right, so then up next on our list is going to be the double top. Okay, this particular pattern is a very easy to recognize pattern, the double top and the double bottom. Okay, the double top and the double bottom is a very, very simple pattern to recognize. Okay, what does the double top and the let's quickly do the definitions. Okay, double top occur when price reaches a resistance level twice without breaking above it, signaling a potential trend reversal to the downside. While double bottom is the opposite, when price reaches a support level twice without breaking below it, suggesting a potential reversal to the upside. Okay, it's a very simple thing. Okay, so now look at the double top here. It's very, very simple. Okay, you can classify this as a double top, but though we had a fake out. Okay, but now look at this. This is even a triple top. 1, 2, 3. Okay, you can see here also double top 1, 2. Price is failing to break this level. If you fail to catch this double top, you can still use this one, 2, 2. If you fail this one, you can still use this one. Okay, so once you see price is failing to break through a particular resistance level, is classified as a double top. And then when price is failing to break through a support level, is classified as a double bottom. Okay, so you can see here, this is actually a triple bottom, but if price hasn't formed here, you can still use this as a double bottom, 1, 2. Okay, even if you fail to recognize this on time, you see this 1, 2. All right, and then you move on. Okay, but this can be classified as what? A triple bottom. Okay, let me look for a very, very clear example of a double top. Okay, so now this is a double bottom here, 1, 2. Okay, this is a double top, 1, 2. Okay, and it happens over and over in price charts. 1, 2. Okay, 1, 2. Okay, it happens over and over and over again in the price chart. All right, so once you see those formations, you strike. Okay, without hesitation. This is a double top, 1, 2. Okay, so these are things you need to understand in price chart. Okay, so double top, triple bottom, similar to the double top and double bottom, but with three peak or trough, indicating a stronger potential trend reversal. Okay, I just showed you they are similar. Okay, they are similar with the double top. Okay, they are very, very similar with the double top. But this time around, it has 3 top or 3 bottom. Okay, you can see them here, 1, 2, 3. Okay, or 1, 2, 3, as the case may be. Okay, once you see that price is failing to break through a particular resistance, and price came there the first time, pushed down, came there the second time, and it's pushing down. Good entry for a short. Good entry for a short. You can take this short, price above. You can start to put it above here. Okay, or you can decide to put that above the range if you get your range properly, and then you target any level. You can use a fixed take profit 1:2, which is what I use consistently, or you can have your own personal take profit level based on how far you've seen the market respect your levels. Okay, so that's just it. All right, so the next on our candlestick recognition pattern will be rectangles. Okay, all right, rectangles are characterized by parallel horizontal line showing consolidation within a range before potential breakouts either to the upside or the downside. A rectangle can be a continuation or reversal pattern, depending on the proceeding trend. Okay, so now this is we're actually identifying a rectangle. Okay, let's see if we can quickly identify one. Um, let's see. Okay, there's one here. Okay, there's one here. This is a clear example of a rectangle. Okay, it could either be a trend continuation or a trend reversal. Okay, you can see it here. It formed a rectangle here, and then we had a breakout. Even here also, this is also a rectangle. After this push, we had this rectangle here. Okay, you see after which formed price pattern in a rectangle and then pushed up. Okay, even here also, you can see the formation occurs over and over again. If you're able to identify this, just mark out the highs, mark out the lows, and then you have a rectangle. Okay, you can see it here, and then you push out of that level. Okay, even here, down here, but this time around, it served as what? A reversal pattern. Okay, it served as a reversal pattern. All right, so this is a rectangle after which price broke above, gave us another rectangle, broke above it, and then we had price delivered to the upside. Even here too. Okay, there's also a rectangle here. Okay, you can see the formation happening over and over again. Okay, you can see the formation happening over and over again. Okay, and in most cases, this rectangle is a range. Okay, is a range. Okay, sometimes it formed during Asian section. Okay, you can see it here. It formed during Asian section. Once you're able to capitalize the range breakout, you can have good movements. Okay, so yeah, the next on our list here would be one. Triangles. Okay, triangles pattern is a triangle like shape continuation pattern. It depicts a drawing trend along a conveying price range. Okay, so triangles are like this. Okay, triangles are like this. This is the way a triangle is. Okay, this is the way a triangle is. All right, so let's identify chart patterns that are triangular based. Okay, let's identify chart patterns that are triangular based. Okay, so let's watch out closely on price, and then let's see if we have any triangular base pattern. Let's see. This might take a little while to identify. Okay, this is what we're actually looking out for, a triangle. Okay, this is what we are looking out for. We're looking for a triangle like this. Okay, we're looking for a triangle this way. Okay, price could actually from the top come range in between this level here. Okay, it could range in between this level here. Okay, and then we could have either a breakout to the downside or a breakout to the upside. Okay, this is what we are expecting to see on price chart. Okay, so um let's see. Let's see. If it's not here, then it's not here. Okay, if it's not here, then it's not here. It's not compulsory that it's formed every single time, but let's see this guy here. Okay, let's see this guy here. Okay, something like this. Okay, form the triangle, give us this pattern, then we had the breakout. Okay, and then, but we had the break in back. Okay, so let's see. What is the strategy called? It's not really a strategy, it's a chart pattern recognition. Okay, it's actually a bearish, is a triangle form. Okay, we have the ascending triangle, we have the descending triangle. Okay, we have the ascending triangle, which is for the uptrend, and then we have the descending triangle, which is for the downtrend. Okay, so this is more like a descending triangle. Okay, because price came from the downside and then was creating this. Okay, this is ascending because it was going up, and then we had a break to the downside. Okay, but if we're going to, let's quickly use the Google to check out the patterns. Okay, ascending, ascending triangles. Okay, so this is the way it is. So you can familiarize yourself with it. Uh, yeah, this is the way it is. So price can come from the top, range, and then have a breakout. Price can this way, range, and then have a breakout. Range, breakout. Range, breakout. Okay, so this is what we are looking out for. All right, so you can take your time, go through your charts, and then yeah, you can take your time, go through your charts to recognize this pattern. And then for the inverse side, we have what? The descending triangle. Okay, the descending triangle is the descending triangle is the opposite way. Okay, that way, this is the way it is. Okay, price will come, range, and then break to the downside. Okay, to come, range, and then break to the downside. Okay, come, range, break to the downside, range, and then break to the downside. Okay, ascending is when it's breaking to the upside, descending is when it's breaking to the downside. Okay, so that's just the way it is. All right, so we can still, if I see them on the chart, I'll still recognize them and then show them to you. Okay, so the next one we have wages. Okay, wages are formed by converging trend lines, and they can be ascending bullish or descending bearish. Okay, it's a continuation pattern, meaning it suggests a temporary pause or continuation in the prevailing trend. In the prevailing trend before price resume its original direction. There are two types of wages. We have the rising wages and then we have the falling wages. Okay, so they are basically the same thing with this triangles. Okay, triangles and wages are still the same thing. Okay, so we have the pennant. Okay, pennant chart patterns is a short-term continuation pattern found within strong trend. It's a small symmetrical triangle that begins wide and then converges as a pattern matures, like a cone. Okay, the pattern indicates a temporary consolidation or pause in price movement before the prevailing trend resume. Okay, it's like a cone, still the same thing like that triangle, uh still the same thing. Okay, so we are looking for pennants. Okay, so let's go to Google and then get a clearer picture of what it's all about. Okay, chart patterns. Okay, so this is the way it is. Still the same thing with the triangle. Okay, so you can either call it an ascending triangle, descending triangle, or wedges or panel. They are all the same thing. All right, so and then the flag. All right, flag patterns are short-term continuation patterns that occur within strong trend. They are characterized by rectangle shape and are named after the resemblance to a flag or flagpole. There are two types of flag patterns. We have the bullish flag and then we have the bearish flag. Okay, so it's just like the regular flag. Okay, so let's see. This is what we are looking out for. Price pushing up, and then giving us something like this. Okay, can either break to the downside or break to the upside. Okay, it's just like a flag. Okay, let's see how the online version looks like. Uh, okay, this is the way it is. You can see it here. This is a descending. This is ascending. Okay, this is descending. Let me open it. Okay. So now this is, I also send a chart pattern. I also send a chart pattern. Who is this? I also send a chart pattern booklet to the group. Okay, I also send a chart pattern booklet to the group so that you all can have a copy. Okay, I also send a chart pattern booklet to the group. Let me save this image, and then you get them in the group. Okay, so this is the way it is. Okay, network is kind of slow. Okay, so I'll just send you guys this picture. Okay, it has the double bottom, the double top, bullish falling wedge, bullish expanding triangle. So you guys can have a look on them. Okay, so you can go through them and then get familiarized with um the pictures. Okay, you can get familiarized with the pictures. Okay. All right, so let's continue. Let's look at candlestick patterns. Okay, candlestick originated in Japanese centuries ago and have since become an integral part of technical analysis in various financial markets, including Forex. If a candlestick represents a significant time period, price movement, and includes information about opening, closing, highest, lowest, highest lowest price within that time frame. Candlestick pattern provides traders with insight into market psychology and potential reversal or continuation in price trends. Okay, so everything you are seeing on the price charts here are candlestick dependent. Okay, are candlestick dependent. So you need to understand certain candlestick that are telling you to buy, certain candlestick are telling you to do what? Sell. Okay, so these are things you need to understand as traders. Okay, so there are certain candlestick you see now, you'll be like, okay, uh, it's time to buy. Okay, and then there are certain candlestick you see, you'll be like, okay, it's time to sell. All right, and that's just it basically. All right, so we'll be diving into certain candlesticks that are giving us information on what in the market. Okay, so now we have the body. Okay, the body represents the difference between the opening and the closing price of the chosen time period, while the wick shadow and its significance. Okay, the wick, also known as the shadow, is extended. It extends above and below the body of the candlestick. It represents the price range between the highest and the lowest price, and the opening or the closing price. Long which indicates higher market volatility. All right, so let's see a clear example right here. All right, so Here is it. So now this is a bullish candle, but it has longer wicks than body. Okay. And then this is a bearish candle. It also has longer wicks. You can see the wicks here, or the shadows is here also. All right. You can also see this candlestick. It consists of what? For a bearish candlestick, let me draw it out. Let's take an example of this. Let's take an example in this place. Okay, so this is the wicks. Okay, now for a bullish candlestick, we have what? The opening price at the top, and then the closing price at the bottom. Okay, let me use the call out tool. So for a bullish candlestick, we have the opening price, then at this area here. So yeah, at the bottom we have the opening price for a bullish candlestick, and then at the top we have the closing price. Okay, so this is the opening price for a bullish candlestick. So remember, a bullish candlestick is a candlestick that is going up, and then closing price at the top. Okay, so if a candlestick closes above the open, okay, it opened here below. Okay, this is the opening price here, and then this is the closing price here. Okay, it simply shows us that what the market opened, buyers pushed the price up and then closed above. Okay, and then these wicks you are seeing here, it simply shows us that what initially this candlestick that you are seeing that closed like this was one time like this. Okay, price got to this level, okay, giving us the high, but what happened? It came back down and then closed. Okay, and then what this also means here is that price at some point got down to this level, and what happened? It came back up here after it opened, okay, before moving to the high. Okay, that just is what it simply means. Okay, it simply means that this candlestick was one time a bearish candlestick, giving us this low point here before going up, giving us the high point, and then closing at this level on this particular time frame. Okay, do you understand what I said? Do you understand what I said so far? Do you understand what I said so far? If you understand, just drop one in the chat section so that I know that you understand what I'm saying so far. Okay, okay, yes, yes, yes. All right, let's go. And then for a bearish candlestick, we have the closing price below. And then we have the opening price above. Okay, so now what this simply means here is the candlestick opened above, came here, okay, came back down, and then what happens? Managed to close here. Okay, or managed to close here, or managed to close here, or managed to close anywhere, as long as it is below the opening price. Okay, now all these different type of candlestick gives us different information. If you can see a candlestick that has a long wick than body, let's say this is the closing price here, it also shows us what potential rejections, because while we price open and then come all the way down to sell and then go back up and close very close to the open. Okay, it simply shows us that what they are rejecting price at that particular level. Okay, which is still the same thing what we have here. Price actually opened. Okay, it opened here below here for a bullish candlestick, went all the way to this top, taking out the liquidity at this top here. Okay, so if you can see here, price actually broke above this level here. Okay, you can see here it broke above but did not close. Okay, what happened? It came back down. The next candle opened, and then pushed all the way down. Okay, you can see it here. All right, so these are things, these are information that candlestick gives us, that we know that okay, it is time to do what, buy, or it's time to do what, sell. Okay, now you can also see this candlestick here. It opened at the top here, came down, but went back up and closed at this area here. Okay, the next candle came, and then we had this push to the upside. All right, so these are informations that you can interpret with market structure, and then you get your potential trend movement. All right, so let's see the candlestick. Okay, doji candlestick. All right, the doji pattern occur when the opening and the closing price are nearly identical, resulting in a cross-like appearance. Okay, this usually signifies market indecision and potential trend and potential reversal point. Although rare, a doji candle can signal a trend reversal indication for analysts. The common example of a doji candlestick are gravestone doji, dragonfly doji, and long-legged doji. Okay, so this is what a doji looks like. Okay, now what does it say here? For you to recognize a doji, it says that a doji occurs when the opening price and closing price are nearly identical. What it simply means is that opening price and closing price are almost in the same area. So this is a clear example of a doji here. Okay, price open, gave us the high, gave us the low, and then closed very, very close to the open. Similar here, you can see it here. All those tiny candlestick, you can see it here also. You can see it here, here also, here also. You can see them over and over on the price chart. Okay, over and over on the price chart. All right, price will open, give us the low point, give us the high point, and then close very, very close to the open. You can see them here. All these are dojis. Okay, but there are different type of doji. We have the dragonfly doji, we have the long-legged doji, we have the gravestone doji. Okay, so with time, you understand the whole psychology. It's very important to understand the psychology behind this patterns formation so that you can be able to recognize them. Okay, so once you need to know about the doji pattern, either the gravestone doji or the dragonfly or the long-legged, is the fact that when they are formed, they have their opening price and closing price similar together. Okay, similar in the same format. Okay, in the same place. All right, you can see them, they open and close in the same, like just 2 pips, 3 pips difference. Okay, so that's how you identify a doji. Okay, so let's go on to the next one. We have the hammer and hanging man. Okay, now the hammer pattern has a small body at the top and a longer wick with little to no high, with little or no high wick. Okay, resembling a hammer. Okay, so it suggests a potential bullish reversal. The hanging man is the bearish counterpart, indicating a potential trend reversal. It's important to note that this only this only shows the possibility of a move to happen, therefore should be combined with other confirmation when trading. Okay, so you need to know that in as much as this candlestick formation occurs, it's only showing you that it's just something that is most likely to happen. It's not a win-win situation. Okay, you need to combine it with other confluences like your support or resistance. If it's possible, it forms on trend lines, is good. You understand me? So now let's try as much as possible to recognize a hammer. Now, the psychology behind a hammer states that a hammer pattern has a small body at the top and a longer wick with little to no highs. Okay, so for a hammer, we have a small body at the top, so with little to no highs. Now let's look for a hammer here. Now this is a hammer. It has a longer tail, okay, to the downside, but with little to no highs. You can see it here. Okay, you can see it here. The highs is very, very little. Okay, let's look for another identification. And this, you can spot them at potential resistant levels. Okay, you can spot them at potential resistant level. All right, so let's see, with little body, the formation says with small body at the top and a longer wick with little to no highs. Okay, now let's see. This is the way you recognize pattern. You just take the psychology behind the pattern and then you try to identify them. Okay, so our network is really bad. Okay, you can just take your time. I'll also send you this a copy of this handout. Okay, so you can get them for yourself and then you read through them. Okay, you can see it here also. A longer wick, okay, and then a body with little to no highs. Okay, you can see the move. The next candle open and then we had this blast. Okay, so you can see they work in confluence with what support and resistance. Now here, what I'm actually identifying here is that we had a shift in market structure, okay, or a change of character as the case may be, because price was creating what bearish move, bearish, and then all of a sudden we had a shift creating what a higher high. Remember, so now this is a CHOCH, and then the next thing after the CHOCH, price came back to retest previous what support and then gave us this pattern formation. Okay, so now you've seen what a change of character, you've seen what price came back to retest previous area of support. Okay, you can see here it held here, struggled through, and then finally broke through, came back, and then it's now giving us what a hammer formation. And now the next thing is that our moving average crossover is taking place. Okay, it's crossing over. So now if you take a buy entry from this level here, okay, and then your stop loss just below the hammer or the confirmation candle, okay, this is a good trade for a 1:2 risk to reward ratio. Okay, though the trade actually gave us more than a 1:2, gave us a 1:5 here. But if you are looking for a 1:2 and then you throw your stop loss, you have a good trade running. And the funny fact here is that this trade just took about 1 hour to get to your TP at 1:2. Okay, so these are the ways we get high probability setup in the forex market. Okay, so we'll reset this link. Let's see how far we've gone. But we still have a whole lot, man. We still have a whole lot to do. All right, so you can see how gradually identifying high probability trade setup are coming in play. Okay, identifying them, adding this one to this one, and then having the candlestick confirmation, and then taking your buy position, you have a trade.